This is Benjamin Ball. I'm here at Super Return US with Roger Brinner, the chief economist at the Parthenon Group. Roger, you gave a very interesting talk this morning, the title of which was After the Great Recession. Now, you seem to have a very bullish view on the US economy. What do you think this is going to mean for private equity in the US?
Private equity deal volume will grow very strongly. We've looked at historical patterns and we think you've got about a 12 to 15% growth in deal volume. And on top of that, you're going to see good returns because, as I also mentioned, I think that public equity market valuations are going to improve the price to earnings multiples, which always translates into higher EBITDA multiples for private equity.
Interesting. But what do you see as the greatest risks to the private equity industry in the US?
Well, the greatest risk is a systematic global downturn in the US. I don't see that happening unless we have some big surprise international event. Something crazy happens in the Middle East, or Europe backtracks and really does collapse. But those to me are less than 5% events, so I am optimistic about the US. We've got some fiscal medicine to digest this year in 2013, so real GDP growth will be weak, 1.5% to 2% this year, but then build to 3 to 3.5 for a couple successive years.
Okay, and picking up on that, one of the interesting things I saw in the talk this morning was your model of, and the research you've done and your theory about what drives equity markets. Could you just outline that again?
Yeah, I think people can make equity markets more complicated than they are. Basically, you say, what are earnings that I can trust? So you look at the last couple of years. You say, what multiple should I put on those earnings? The multiple is really only a function of two things. What's the competing yield on treasuries, and how much risk do I think there is? I like to gauge risk by things not like a volatility index, but more by market measures like the spread of the double B to the AAA corporates, or these days the PIG spread over the German sovereigns. As those spreads have come down, that's powered the equity market this year. The equity market isn't growing because the world is growing. We know Europe is still in a deep recession. So it's really the risk coming out of the markets. Then we go to the second stage for the equity markets, which is global growth being better in 2014 to 16.
Okay, so we talked about US. Let's look at Europe. Again, you said this morning that Europe will risk another lost decade because there's stupid macro policies. How do you see the markets in Europe behaving?
Well, what I meant by the stupid macro policies is in the 1980s, they had what was widely referred to as a lost decade because they didn't know how to cope with both the OPEC shocks and then the high interest rates of the Volcker regime. They didn't know how to counteract those. This time, they have failed in putting in more stimulus, both Germany on fiscal policy and the European Central Bank being very late to the game. They still don't quite understand that they need to have a balance to get growth reignited. So if they keep hemming and hawing, they're going to have public revolts, student revolts. The unemployment is horrible in the periphery. So they need to take some action.
Okay, so that's America, that's Europe. You're bullish on the States, negative on Europe. What about China? What's your view on China?
I think China is following the model quite well of Japan, and then a couple decades later, Korea. They're managing their exchange rate well. It's still very competitive, even with their rising labor costs. They'll let it rise 3 to 5% a year to stay in the game competitively. What I really like about China is their consumer is starting to spend. The middle class is growing, and consumers accounted for more growth than exports last year. That's an important transition.
Okay, Roger, thank you very much indeed.
Enjoy talking to you.